Hey guys, a lot of people right now are chasing this market, trying to find trades, following the news, trying to front run headlines, trying to buy the dip, hoping for some kind of taco or whatever. And they're losing a lot of money. They're really struggling because this is a very bad market and you frankly shouldn't be trading. So in this video, I'm going to give you guys 3 things to look for when it's safe to start sizing up and start getting a little more on the offense with trading. By the end, you guys should know exactly what to look for, what to watch for signs that it's safer to start taking positions and start adding some size to your trades. So let's get right to it. The time of this recording, it's March of 2026. The war in Iran's going on. And look, that's driving 70% of the market move. Okay. So that means if, magically someone could wave a wand and the war would be over and the Straits of Hormuz are open and the oil infrastructure has been rebuilt, it's not been destroyed, and all the oil rigs that are taken offline wouldn't take 9 months or a year to get back up to speed. And it wouldn't take 9 to 12 months to get back up to normal capacity, because it's going to take 9 to 12 months, whenever the war ends, for things to get back to capacity and for the price of oil to come down. If that could just happen overnight, the market would probably run fairly significantly for like a week to like 7 to 10 days, like maybe a couple of weeks. Like it probably moved pretty hard. Okay. But we don't know when that's going to happen. We don't know if it's going to happen. Even if the war ends and things start going back to normal, there's still going to be a recovery period. Right? Look at the times in the past where there have been problems with the Middle East and serious disruptions to the oil market. Okay. So we can't really do anything about that. What can we as retail traders, and how do we as retail traders know when it's safe to start adding size back to your trades? Because right now we're in survival mode, right? Yes, there are some trades here and there to be had, but in general, you should be 95, 100% cash. Maybe you short the market like we did here, but you should be basically sitting on your hands, studying, learning, preparing, honing your craft, getting your tools ready. So when the time comes, you're ready and you're in a position that you can take advantage of the upturn in the market with a clear mind, with a clear head and a clear scope of what you're shooting. So the first thing that we want to look at, so we're looking at the cues here. We want to look at this red line. This is the 20-day simple moving average. The first sign you want to look for is for price to be above the 20-day moving average and the 20-day moving average to be moving up. The second thing, we want to look for higher highs and higher lows in the price action. If we look at price action now, what do we have? All right, let's zoom out a little bit. So here was all-time highs, January 28th. Since then, let's look at the chart. We have a lower low here on February 5th. That low is lower than the one we had on 21 January and lower than we had on 17 December. So this low is lower than the previous lows. So it's a lower low. Price comes up, tries to get back to all-time highs. Does it? 11 February? No. It makes a lower high and then starts going back down. Okay, so we have a lower low and a lower high. Hey guys, this video was a condensed look at a much larger strategy and a much more detailed piece of content. To get the full detailed version of this video, plus access to our daily live streams, a vault of exclusive content, you need to be in our room, The Construct. The Construct is dedicated to helping you not only grow your expertise and skills as a trader, but also grow your portfolio. So stop trading with half the picture and click the link in the description below to join The Construct for free. We'd love to have it. Price goes sideways for a little while, and then here on 3 March, price makes another lower low. It tries to recover a couple of days later. Can it get as high as it did in February? No. So we have lower lows and lower highs. Lower lows, lower highs. And then we lost the 200-day moving average. And since then, look, lower low, lower high. And then clearly the last few days we're making lower lows. Okay. We want to see higher highs and higher lows. All right. So what does that look like? So I'm gonna give you 2 examples on the chart. I want to get rid of this so it's a little more clear. So let's go back a year, right? The last time we lost the 200-day moving average. Price loses a 200-day, we make a low, we try to make another high, try and get above the average. It's a lower high, and then we have lower lows. We try and make a high, and we make lows, and we sell off for a few days. Okay. What are we looking for here in 2025? Higher highs and higher lows. So where would our highest point be on the chart here? Where would our new higher high come from? Let's look at 9 April. We have this big update here. This is a huge update on the market. So this would be a higher high. So then the question is, after this high point, where is the next low point? Does price make a new low and go lower than it did before that? Or is it higher than it was before that high? In this case, the low price point here on 21 April, price recovers and it moves up. After this high, we have a low and then we have a higher high. This higher high confirms this is a lower low. You have to have both. You can't just have a higher high or a higher low. Your higher high confirms your higher low, and your higher low confirms the higher high. That's a mouthful. So I'm going to let's go to another chart, another example, so I can try and make this a little more clear, because this is something that can confuse relatively new traders. Okay, so we're going to 2022. This is when the Federal Reserve started raising interest rates after COVID and the market started selling off, right? So let's plot the way down. We had all-time highs here on 21 November. And where was the most recent swing low before that? It was here on 10 November. So price moved up, it made a low, and then what did it do? It made a new high. So we have a higher high that confirms that this was your higher low. And then does price go on and make a new higher high? No, it doesn't. What do we get? We get lower highs and lower lows, lower highs and lower lows. We try to get a higher high here. It does get above the highs of December, but does it get back to all-time highs? No, it rejects it, and then price starts making lower highs again. So then we're back in the trend. Lower highs, lower lows. We lose the 200-day. You see here, lower highs, lower lows. We try to make, and this is the point I'm going for here. So we lose the 200-day, January of 2022. We get a new low on price. Okay, so we have a new trend. We have a new low. Price tries to make a higher high, right? It comes up, it gets above the 200-day, and then price starts to sell off. Does it get as low as it did in the last week of January? No. We have here a potential higher low. So then we look for the next high price. When you have a potential higher low, you go to the highest point that price made before the previous low. You have two low points on the chart you're looking for. This was our recent swing low, and this would be our new higher low. So you go to the lower low and the new higher low. You look at the highest point that price attained in between those 2 points. That is your lower high. That's the point that price has to clear in order to have a higher high. Does price do that? No, it doesn't. So this higher low is invalidated. And then sure enough, price takes it out. Again, here, you can look at 14 February. Price bounces and tries to move up again. Does it make a higher high in between the lows? No, it doesn't. It makes a lower high. So that low, that higher low is invalidated. And then sure enough, what happens? Price goes even lower than it did in January. Same thing happens. So 24 February, all right, we have a low. Price tries to come up and recover. Where is the most recent low? Where is the most recent potential higher low? It would be here. This was your most recent higher low, 24 January. So price would have to get all the way back up to 360 after this lower high to invalidate this lower low. Price would have to get back up to 360. If it did, this would be invalidated because we'd have a higher high. Does it? No. And we come down here, we bounce. Can we make a higher high? Nope. We take out the lower low, come back up. Where was the level we talked about? The previous high. So what we have now is the previous higher low. The previous higher low. And we have the highest point between that and our new lower low. So in order for us to say we have higher highs, we have to take out this day here, 2 February 2022. And what happens? We take it out. 29 March 2022, we take out this higher high. So you can say, okay, cool, we have a higher high and we broke above the 200-day moving average. Now, does it hold it? No. We come down here, we sell off, price tries to recover, and it can make a new high. If price after this point can get above that 360, let's call it 362, then we would have you could say we have a new trend. This would be our higher low, and this would be our higher high. Cool. Party on, man, right? It can't do it. Lower high, and then sure enough, we take out the lower low, right? So price is going down, lower highs, lower lows, lower highs, lower lows. Okay. Again, we get a lower low here. Here was our previous lower low, 12 May to 20 May. This is our low. Sorry, this is a lower low. We make another lower low. So where's the level that we have to take out to make a higher low? The highest point between these two lows. I know I'm saying lows and highs a lot here, so I hope we can keep up. The lower high here, 296, we take it out. And we take it out for several days, for a couple of weeks. Price is hanging out here. Cool. So in order for this to be a change in trend and a change in market sentiment, what we would need is for after price takes out this potential higher high, and it does, cool. What do we need to see now? A higher low. Again, you have to have higher highs and higher lows. You can't just have one or the other. You have to have them both occur sequentially in order to have a change in trend. And then after this, so what's the level that now our low needs to hold? The most recent lower low right here, 272. Does it hold it? No. We take it out. And importantly, look at the volume. We take out that lower low on volume, on an increase in volume. But here's what we're looking for. After that point, so we have our lower low, okay? Price comes up, tries to make a new high. Can it make a new high? Can it get back to this 306 area? No, it can't. It can't get there. So that's the point between our lower low and lower low. So it can't take that out. But price does recover. It gets up to 289, tries to make a lower low. Does it clear the 262 level? No, it doesn't. It holds and forms a potential higher low. Okay. So now we have a low, we have a lower low and a lower high. Okay. So that's the trend. The trend is down, but now we have a higher low. So we have a potential of a trend change. So in order for this trend to reverse, the lower high has to be taken out. And for charting purposes, you need to take it out with a close. Price needs to close above this level. So here on 8 July, does it close above that lower high? No, it like touches it to the penny and rejects almost, but it's not a lower. I would say this is a stable high. You didn't make a higher high, but you didn't make a lower high either. Okay? So this is something to pay attention to if you see this action in the market. Then we look for, okay, what happens when price sells off? Does it make a lower low? No. So we have two higher lows in a row here, right? Or actually, yeah, you have two higher lows. Okay. So again, in order for these higher lows to be valid and for us to say a trend changed, we have to go to the highest point, the lowest high point. We have to go to the highest high point in between the higher lows, because now we're looking for higher highs, not lower highs. So we go to the highest high point between the higher lows. Where is it? Same thing. We talked about it. Let's call it 289. So if price takes out this 289 with a close, we have a confirmed higher low and a higher high, and the market becomes not safe, but safer. Now you can feel more comfortable with applying size to your trades. And what does it do? 19 July, we take out this lower high. Now we have higher highs. So what would that look like on the chart? So as this is happening, like this is what you're seeing as the market is occurring. These are the daily candles. So look, you get this, price comes up. Does it make that new high? No. So that's what you'd see. And then the next day happens, it's going lower. All right, make a low. Oh, we had two days down here around 273, and then we have an up day. So now we have a potential higher low. And then what happens the next day? The market opens up, and then sure enough here, now 19 July happens. And what does this look like on the chart? This is what price is above. Let's mark it. Price is above this 290 level. Let's call it 290. We get a close above it. So this is what it will look like on the chart. This is what you'll see. Okay. This is what you'll see right here. This is what a bottom will look like. It's not going to be this massive green Hulk candle. It's going to be this right here. Okay. It's going to be well below the 200-day moving average. But look, we have a low, a lower high. Then we have a higher low, right? Notice the trend shifts. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. A higher high. Do we get a higher low? No. Lower lows, lower highs. A higher low. That's interesting. Do we get a higher high? No, not yet. But we get another higher low. Then do we get a higher low? A higher high? Yes. So now we have a higher low and a higher high. The market is good. You can start applying size to your trade. And look what happens on this day. Let's scroll forward so you can see the chart more clearly. We're talking about this day right here. Hey guys, look, this clip is just a glimpse of the kind of research, education, and training content we do in the Construct every single. To see the full version of this training and unlock over 100 hours of trading and investing educational content, join us inside the Construct. I'll show you exactly how I leveraged these tools and techniques and my strategy I used to retire at 35 while working a full-time 9-to-5 job, working over 60 hours. From daily live streams to proprietary research, it's all waiting there for you, including a supportive community of like-minded traders and investors just like yourself. Use the link in this video to start your free trial in Construct today.